Yeah, so here we are. Welcome to the webinar, our last one before the main big event of the year, the grand finale. So let's kick it off. Welcome everybody. I see some familiar faces here. Let's start. I'll start by presenting myself. My name is Yochai Lam. I used to be a retail trader, a computer programmer. I founded Forex Watch back in 2008. Yeah, around that financial crisis. And I joined FX Street 10 years later in 2018, nearly 5 years at the company, and I'm leading the premium content. And my focus is fundamental analysis. We'll talk about right now. So talking about the premium content, let's talk about table of contents. We'll talk about 4 huge events next week. US inflation on Tuesday, the Fed on Wednesday, and then we have double feature ECB and the Bank of England on Thursday. So yeah, so talking about content and premium content, I'll do my quick pitch for the premium section. We're in the last hours of our very extended Black Friday offering. What do we have in FX Premium? You might be asking. So tap into the experience of Tomas Sayes, Ivan, Brian, and myself. We talk about Forex mostly, but also stocks, crypto, commodities, and we have trade plans. And I think the best feature, for some people know it, is our community. We have a great community where you can ask us any question, and you get to not trade alone, to be with like-minded people. This is our community. You can access us. Here's myself answering a question. We have these trading alerts, trade plans. Tomas is doing that. Lots of interesting stuff there, and we have great feedback, lots of positive feedback. What I need to know when I need to know it. Excellent insights. You really inspire me, and we keep on getting these positive insights. Well, we have lots of experience in the field. So this is, well, if you're still not a premium member, this is your chance to sign up. We have this special offer. I think I didn't prepare the link. Here we are. So I'll share the link with you here on the chat. Anyway, it's just first month $9.99. It's 75% discount. Or if you sign up for a year, you get basically well, it's 50% off. It's yeah, 50-50. Yeah, no. So here you go. If you missed the Black Friday offer, you can still with the flu. Oh, sorry to hear that. Yeah, it's not only COVID. We're not going to talk about COVID today, fortunately. But anyway, for those of you still not in the premium section here, you have these extended Black Friday offers, and yeah, they're in their last hours. It's hard to convince management to keep these discounts for much longer. Black Friday was a week ago, 2 weeks ago almost. Anyway, so let's begin talking. You have the link there to sign up to premium with the special offer. U.S. inflation, that comes up on Tuesday. This is the most important event in markets in terms of volatility. The Fed matters, but the Fed tells us that what matters for the Fed is inflation. They're focused. They have 2 mandates, the Fed. They're focused on inflation, not employment. So this was the big movement here in dollar yen that we had last time. That was November 10th. And this Tuesday, December 13th, we have another CPI. So it's important. Biggest market mover because of inflation. Last time, markets really liked it. The dollar fell. Stocks went up because it was really low. This time, yeah, it's the same. I still expect a huge impact, even more because it's 1 day ahead of the Fed. The most important figure to look at is core CPI month over month. Last time it fell from 0.6 to 0.3. I'm sure it'll go up this time. The question is how much? Okay, I expect it to rise above, well, be above 0.3%. It's a figure for the month of November. Okay. And yeah, I think that it could be really huge. It could be strong. It'll show that last month was maybe not a one-off, but just a temporary dip, and now inflation is still strong. I think markets will freak out because of the importance, because of the timing, the last rate decision of the year, 1 day before, and after they were so convinced that the Fed is, well, they're going to slow down, but maybe they'll have to move really fast. So I expect something like 0.5, 0.6, and that would boost the dollar. But after this initial surge around around the inflation release. It's a Tuesday at 1:30 GMT, 2:30 here in Barcelona, or 8:30 if you're connecting from the east coast of the US, from New York. Then it's going to be a crazy event that'll have an impact for quite a few hours. But then I expect things to suddenly come to a halt because one day later we have the Fed decision. And the Fed decision is a bit more, well, a bit more complex. It always is for various reasons. First of all, let's start with the obvious. The Fed is going to slow down because Powell said so. Powell is the chair of the Federal Reserve, Jerome Powell. This guy here, this is not a real picture. This is a meme, of course. He's releasing a dove. He said that the pace of rate hikes will moderate in December. That's right now. So instead of 75 basis points, 0.75% rising each time, now they're going to raise it by 50 basis points. That is fully priced in. So if you're new to markets, you might ask, well, why did the dollar fall? Because after the Fed raised rates, because it was fully priced in. Will the dollar fall? It depends not on the rate hike, that's fully priced in, depends on other things. It depends on what the Fed says about moving forward. What's next? They'll probably move the goalposts. Of course, they had to put something related to football in this presentation. We're between the just before the quarterfinals, right? So I won't tell you who I'm cheering though. Anyway, all eyes are on the dot plot. Once every quarter, not every second decision, the Fed releases not only its rate decision, but also forecasts for growth, inflation, employment, remember the second mandate, and most importantly for markets, interest rates, okay? So this is called the dot plot. If you hear this term for the first time, don't be afraid, it's basically forecasts. And there's really one number that is important for markets with all these dots and all the figures on the screen. It's what the final interest rate, terminal rate, the long-term rate. In this case, it's the figure for 2023. It stood last time was September. We had warmer weather. Now it's a bit cold. Then it stood at 4.6%. Now it's going to rise. But how much is it going to rise? 5%? That's a very round number. Now, market expectations, bond markets have been foreseeing just under 5%, just above 5%, sort of seesawing around that number. We had forecasts from Goldman Sachs, if I'm not mistaken, talking about 5.5% is the maximum interest rate. I don't know. There are many voices in the Fed. I'm not sure it'll go that far. And their forecasts depend on how they see the economy. And this is my next slide here. Lots of ins, lots of outs, lots of mixed data for those Lewowski fans. Anyway, manufacturing is down, very poor data when we had the ISM manufacturing last week. And then we had services going up. So yeah, services are more important. So the US economy is doing well, right? Because it's 80% of the economy, 80% of the labor force. Wait a second, but then housing, the housing sector prices fell, the number of deals fell, everything is going down. But then suddenly there are signs it's stabilizing at lower ground. So yeah, interest rates mean higher mortgages, mean cooling economy. People don't move house because it's too expensive, because mortgage is killing them. But now it's stabilizing, so maybe the situation isn't so bad. And consumers, we have, for those of you here and not watching the recording, we have the University of Michigan's consumer sentiment on Friday. It's going to be bad because consumers are worried, right? But they're worried about inflation. Inflation affects everybody, even not only those unemployed, but they're crying and then they're buying like crazy. Black Friday or not Black Friday, everybody had Black Friday, and these doorbusters work perfectly well. So consumption is still strong, and the job market's, well, relatively strong. Last non-farm payrolls, we had that just 1 week ago, came out at 263,000, above pre-pandemic levels, which were around 200,000, beating estimates. Wages were strong, so if people make more money, then they spend it, right? Then the economy looks strong. Yeah, but then if you look at the details of the non-farm payrolls report, you can see that it's comprised of two surveys. One was strong, the other one was quite quite weak, quite flat. So you can see mixed figures everywhere. The JOLTS survey, that's job openings, it showed it's off the highs. It's not at the peak that it was above 11,000. So we're looking at some kind of a slowdown in hiring. Slowdown, but from extremely high levels. Again, very mixed pictures. So when we're mixed, we ask this guy, what's next? This is Nick Timmy Rouse. He's a senior reporter for the Wall Street Journal, and he has nice access to the Federal Reserve. This is his Twitter picture. He doesn't look like this black and white in reality. So he said what to expect, 50 basis point rate hike and an aggressive dot plot, okay? That means they're raising expectations for future rate hikes. The big question for markets is, will the Fed raise rates by 50 basis points also in February? February is the next rate decision. I think we could see that, but we also have to think about Powell, Fed Chair Jerome Powell. So we have at 7 p.m. GMT, the rate decision and the dot plot at 7:30 GMT in the evening. We have the rate. We have Jerome Powell's rate press conference explaining all the stuff. Last time he was dovish. Last time he said that we don't want to over tighten. We don't want to crash the U.S. economy. Very different from his speech in Jackson Hole. So 3 months have passed and Powell is changing his opinion. Yeah, so these are the main quotes from his speech. So what do I expect from the Fed? I expect the dollar to jump on the statement, on the dot plot. Expect the markets to react positively, not to the rate hike because that's priced in, but to expectations of when the Fed is going to raise rates, okay? And to what level. I think it'll be relatively aggressive. I think markets will begin pricing in a 50 basis point rate hike for February as well. And the terminal rate of now it's sort of hugging the 5% level. I think it'll move towards 5.2, and that's really dollar positive. But then it might fall on Powell. Powell might try to calm down market nerves, say that, yeah, we'll work steadily. We don't want to wreck the U.S. economy. We're raising rates now. We expect them to rise higher, but we'll move according to the data. And why do I think that? Why do I think it'll be a one step up for the dollar, then one step down? Because we've seen that before. We've seen in the last rate decision the dollar falling when the statement was perceived as dovish, and then jumping when Powell talked about raising the terminal rate. So these seesaws are common, and these kind of seesaws are also opportunities. So I expect the dollar to jump in response to the rate decision, and that gives an opportunity of half an hour to sell the dollar. This is not trading advice, this is my opinion. I'm trying to give you food for the thought. These are my expectations. First up, then down. Make a short pause here if give you a chance to ask questions. So, or I'll continue with the next events. I'm going according to chronological order. So we had CPI on Tuesday. Talked about that. We talked about Fed decision, main event of the week. CPI is the biggest market mover. Fed decision and the main event could have a long-term impact, a slower one. That's on Wednesday, and on Thursday we have two events. I'll begin with the Bank of England, which just comes first, comes at 12 GMT. Okay, we have a relative state of calm after a period of anarchy in the UK. So politics are stable only for now. We have Prime Minister Rishi Sunak in his job for, well, longer than the previous one, longer than Liz Truss, so that's relatively stable. We do have infighting within the Conservative Party, but for the Bank of England, it means a bit of calm. Inflation will get updated UK inflation on Wednesday, so just hours before the Fed, after US inflation. I didn't prepare anything special for that, but we know that Eurozone inflation dropped in November because of energy prices, because we had a very mild October. It was really sunny and nice here, and the same probably happened in the UK. So I expect that to be another thing that will calm down pressures on the pound, on the Bank of England. There's no press conference this time. Well, the Fed releases new forecasts, the ECB as well. We'll talk about that shortly. The Bank of England doesn't release it. It's Super Thursday. It's only in February, and it was in November. So this one is a relatively calm one in terms of action. But there are still lots of uncertainties about the UK economy, lots of strikes going on. Somebody said it's an advent calendar of strikes, so people are getting ready for Christmas, one strike at a time. Brexit is still an open wound. British economy hasn't recovered to pre-pandemic levels, contrary to quite a few other economies. And energy prices are, of course, a huge uncertainty for everybody. Okay, so I think the Bank of England, we don't know if it's going to raise rates by 75 basis points like last time, but I think they'll moderate it down to 50 basis points. They told markets, they told us that they want to calm, that they see the final interest rate at a lower place than where markets see it. This is their chance to walk the walk, not only talk the talk, and I think they'll raise rates by only 50 basis points, and that could calm things down. They also hint in their statement, again, only a statement, no meeting minutes, no forecasts, no press conference, that they intend to further slow down the pace of rate hikes just as winter comes in and all this gloom comes. And I think it'll be negative for the pound. I think that markets are not fully pricing in a 50 basis point rate hike. Some see a 75 basis point move, and we could see the pound falling on this gloom from the Bank of England. Andrew Bailey, the guy here in the previous slide, he's always so negative. You can say honest and telling the truth, I agree, but it's not so good for the pound if you're bull on the pound. Okay, and yeah, let's continue to the last event of this super week, the last important event of the year, and a very packed one, the European Central Bank. Okay, these are confusing times. In the Eurozone, we have, like in the Bank of England, it's unclear if they're going to raise rates by 50 basis points or 75 basis points. Now, in the UK, you have a 9-member monetary policy committee, and you have a clear leader, Governor Andrew Bailey. In the Eurozone, we have 19 different countries. Next year, it's going to be 20, so at least it's going to be a round number. But we have, yeah, and also other governors and people pulling in different directions. Now, what's going on here in the Eurozone is that the data is better than expected, especially hard data about just the third quarter. Germany, despite soaring prices of gas because of the war, despite worries about other issues about the future. Remember, Germany heavily relies not only on gas for heating, but also for its heavy industry. So despite that, the economy grew. Here in Spain, the economy is doing very well. There's a shortage of jobs. Tourists are coming. And yeah, but forecasts are a bit gloomier. So forecasts are talking about a recession next year. I think it's realistic because eventually these high energy prices will come to bite us all. And forecasts sometimes just fulfill themselves. Okay, it just if people expect bad things to come, they react. They buy less stuff, and then the economy slows down. Eventually, reality will bite, like in this 90s movie. But for now, we have a mix of stuff. We had a hot October, as I mentioned. It brought a sigh of relief. Here's a picture of this artificial beach in Paris. And then we have also the Brandenburg Gate in Berlin, covered with snow. It's becoming much colder now. This week is especially cold. Just normal winter, but talking about the weather because it really makes a difference for the mood of economists in the old continent because of this man here, Vladimir Putin. So yeah, this is also important to note. German industry here, BASF, sorry, one of Germany's leading chemical companies, and you can see here the pipelines running well from the east and coming into Western Europe. So there are no worries about shortages, no blackouts expected this winter, but high gas prices just leave less money in our pockets for everything else. So this causes a lot of uncertainty. Now, inflation dropped significantly in the Eurozone. I mentioned it because of that hot October, right? Headline inflation tumbled, but core inflation, this chart below, remains elevated. So prices that, what's core inflation? Prices that do not include energy and food, which are highly volatile, they remain high. They're actually going up. Okay, they're not as, it's around 5%, not as high as in the US, 6.3, but still getting high. Wages are rising everywhere, and I think that will lead the ECB to take into account. Forecasts point to recession in 2023. Again, gloomy forecast, but I see this high core inflation and relatively lower headline inflation as an opportunity for headline inflation at 10%. This is an opportunity for the ECB to act, to raise rates sharply before the window is closing, before they will be unable to raise rates. So this is the last chance saloon. I think we'll have a 75 basis point rate hike, and the ECB hawks are in control. The Germans, the Dutch, and others, they want to fight inflation. They see core inflation. They're afraid it'll get out of control. So I think they'll get that. And they'll take advantage of growth so far and take the opportunity to raise rates while they can. So what I expect, I think, as always, it's a Euro fudge. We'll get a mix of, on the one hand, we'll have a higher interest rate than, well, markets don't have a clear picture, and that'll trigger sort of a spike up in the Euro, 75 basis point rate hike, but we'll have a bit of gloomier forecast for 2023. Perhaps the ECB will finally say that a recession is not only a potential, but a near certainty or certainty, at least a mild recession, and they'll promise to slow down in the next move. It's always a compromise in Europe. Again, 19 countries in the Eurozone. Lagarde is more dovish, Christine Lagarde, the president of the ECB, but the hawks are in control. The hawks have been vindicated. Inflation is high. It's always a compromise in Europe, sometimes called Euro fudge. I feel like eating chocolate. Anyway, so what I expect is euro dollar to rise on a rate hike, from a bigger rate hike than expected, 75 basis point, and then to follow with Lagarde, her press conferences. Sometimes hard to follow even for people like myself who can't live without following central banks who follow every word, but she says things in such a confusing way. I think that she'll just create a bit more uncertainty and also a dose of gloom, not like Bailey, but a bit of gloom. So I expect euro dollar to fall with Lagarde. Okay, that's what I have prepared for you for today. I talked a bit fast. Hopefully this will be useful for those watching the recording, but I see quite a few people here live, above 40, and this is your chance to ask questions in the chat about anything that you wish, and I'll do my best to answer. You're welcome to ask questions unrelated to these events, but these are really huge events, so I think these are the biggest market movers. After that, we'll have 2 weeks of calm for the end of the year. And then, January begins with non-farm payrolls, but yeah. So while we're waiting for questions, I'm looking at the chat. Let me also look at please ask your questions in the chat. Okay, we have a question. Where will euro dollar go? Well, question above that. Only thanks. Where will euro dollar go? So I expect euro dollar to move up in response to the rate hike if we're talking about the ECB, and then fall. But it'll be much more complicated if we go back to Tuesday to the CPI release. I think it'll be stronger than expected, so I expect euro dollar to fall and then wait for the Fed. And with the Fed, I expect the Fed to initially be relatively hawkish. So the dollar to go up, that means euro dollar another leg down. and then move up with the dovish statement by Powell, and then with the ECB to move initially higher and then fall. So yeah, I should have prepared a chart for that, but it's basically Tuesday noon here, our time, big fall, then flat on Tuesday, Wednesday, then another quick fall with the Fed, but then a bounce on Wednesday evening, then another rise on Thursday, but immediately a fall afterwards. So I hope that answers your question. Yeah, you can watch a recording of this. We have a question here about want this presentation, late join the session. You know what? I can share this presentation on the premium section. I see you're a member, and anyway, the recording will be available for everybody. Gold price prediction next week, bullish or bearish? Regarding gold, factors unrelated to this presentation, situation is relatively bullish. We've seen a report from the Global Gold Council. They see growing demand. Now, there are some rumors that Russia might sell oil for gold. I don't know if it's true, but it also adds to the positive vibes. So I think for gold, there are some good fundamentals unrelated to this. But strong inflation means weaker gold, okay? Hawkish Fed means weaker gold. Dovish Fed means stronger gold. Gold is highly correlated to US 10-year yields. They've been falling quite a bit. This is another positive factor for gold, but it'll be quite messy next week. The ECB and the Bank of England have hardly any impact on gold. So if you're looking for high volatility in gold, and it's Tuesday, the US inflation, which I believe will be negative for gold, but it could prove a buying opportunity because other fundamentals are positive. And I believe, I mean, if you by my arguments that eventually gold will be, the Fed will eventually be relatively dovish. Powell will be. More questions here. What a surprise. Well, what would be a surprise if US interest rates were hiked? No, I don't expect any surprises from the rate hike itself. The Fed signaled 50 basis points. They'll do 50 basis points. If inflation goes way above expectations, let's say core CPI month over month is 0.8 or 0.9%, okay? Highly unlikely. There is an outside chance that that happens. In that case, we might get this guy, Nick Timiraos from the Wall Street Journal, talking about a big rate hike eventually, okay? So if we get that kind of thing, then we can get a 75 basis point hike, but we'll get the shift in expectations already on Tuesday, not Wednesday. And if it'll be extremely low, let's say core inflation falls, is negative, then okay, we might get him hinting of a 25 basis point hike, and the reaction will be on Tuesday, not on Wednesday. Basically, I would say 99% chance they'll raise rates by 50 basis point hike, and if not, they'll signal it in response to inflation. So I expect no moves from the hikes. Markets are focused on the dot plot, on what the Fed says about the future and what Powell says about the future. More questions here. U.S. crude. I'm a bit perplexed by the fall in crude prices. Yes, we have more production in the U.S. and we have recession fears. On the other hand, we have more Russian oil reaching China. We have, OPEC Plus refusing to increase supply. We have inventories falling, well, in some categories, not all of them. My colleague Ivan in the premium team had a long piece about that. Very interesting stuff. So I think we can expect a bounce in oil prices from current levels. Regarding next week's events, the lower inflation means shallower path of rate hikes, more demand for oil, stronger economy, more demand for oil, and the price would go up. If we have weaker inflation, if we have high inflation, more hawkish Fed, then we can expect an economic depression and then, an economic downturn because of rate hikes, because of and then oil prices to fall. Hope that answers the question. And premium member, please. Yeah, we'll drop that. We'll drop that over there. Long dollar is looks like it will be interesting to say the least. Yeah, undoubtedly it'll be mad. Again, this is for those trading markets, for those following markets. We're talking about 4 huge events packed within 3 days, and we have other stuff there as well. If you're trading the pound, we have UK CPI. If for any reason you like the Swiss franc, we have a rate decision in Switzerland that happens only once every 3 months, and they provided surprises in the past. I expect a 50 basis point rate hike. And we also have the last minute scramble before Christmas. So yeah, it's not the end of the month, but the following week is already Christmas preparations, no big events, and then the week between Christmas and New Year's is really snooze fest usually. So yeah, it's really it's a festival for those into central banks. Yeah, so I certainly concur, Patricia. And switching dollars into euros long term. Long term, I don't know what you define, how you define long term, but if we're looking into 2023, that's enough long term for traders, maybe not for central banks. I expect the dollar to fall. I think we, the globe, the world, we had enough. It's a negative thing. When the dollar is strong, it impacts negatively, impacts trade all over the world. Think about a company in Brazil trading with one in China. They trade in US dollars, and when the dollar is stronger, it impacts trade. It also causes other central banks to raise rates. The Fed is the leader, the other central banks are laggards. So it could hurt especially emerging markets, could hurt Europe here. We all need a weaker dollar to party. I expect 2023 to be a bit like 2009, and we'll see economic suffering. We'll see people laid off, unfortunately, but we'll see stock markets rising, and we'll see the dollar weakening, and everybody else, all the other currencies moving up. Expect commodity currencies to do especially well. They tend to move just more than others, and yeah. So if that's long term, I expect, for me, everything I've talked about today is, I mean, if you want one headline, is the dollar's last hurrah, because of relatively strong inflation and because of higher forecasts by the Fed. Again, I think it'll be somewhat softened by dovish comments by Powell. Yeah, I hope long term, cool, best to stay flat next week. Well, I'll give general advice. If you're sure what to do, if you have a strong conviction, if you have experience, there's no reason to stay flat. If go with what you think, go with your trade plan. It can be technical. I didn't talk about technicals here at all, but if you're sure about what you're doing, go with that. No reason to stay flat. If you're new to markets, I would say stay out, just watch, just observe what's going on. Use this as an observation experience. If you have a bit of experience, but you're unsure, you don't want to be caught up in huge events, and we often see these crazy whipsaws, especially around the Fed, but also around the Bank of England and the ECB, not so much around CPI, then I think we'll have, then we can use, what I want to say is, if you have a bit of experience but you don't want to get caught in volatility, use a demo account to trade, or trade with smaller positions than usual. Yeah, hedge your bets. Okay, natural gas consumption in the US reflects bearish. Yeah, natural gas is on the rise now because it's getting colder also in America, and it happens every year. It's called winter. I don't think it's an extreme phenomenon. What we do have, what is special this year, is huge US exports of liquefied natural gas, LNG, to Europe, and it's ramping up. So if temperatures fall here in Europe, we'll see more exports from the US and higher prices in the US as well. But there's also, again, a seasonal factor, and storage facilities are quite full here in Europe for this year because we had a hot October and because Europe grabbed every LNG ship it could put its hands on during the summer. So, but I still expect Europe to buy every possible gas shipment it can put its hands on. So, yeah, I expect prices to rise with a mix of seasonality and external demand. How come oil tends to rise when the dollar is falling? Well, the easy answer is that oil is denominated in dollars and that there's traditionally an inverse correlation between, I mean, when you have a stronger dollar, it means more rush to the safety of the US dollar. The global economy is suffering, less demand for oil, and the other way around. But it doesn't always work that way. When we have OPEC decisions, we can see the dollar doing its thing and oil doing its thing, separate worlds. So the correlation is not always there. OPEC decisions or decisions, well, from the US to either deplete their strategic petroleum reserves, SPRs, and now replenish them. So there are, of course, factors in oil. China has been a major factor. So China is now reopening, a bit disorderly, but this is positive for oil. That's why I'm surprised to see oil prices falling. I think they'll bounce from here. Yeah. Hope I have answered the question. 11 years of experience. Yeah. So if you have 11 years of experience, I mean, well, you have 11 years of experience, and if you have a strong conviction about what's going to happen during the week, the entire week, a specific event, then go for it. I don't see, I mean, if you have confidence, go for it. No need for analysis paralysis. If you're not sure, yeah. If you're in doubt, stay out. That's a bit of a dash, but okay. We all need a weaker dollar to party. That will be what I take away from this webinar and bear in mind in general. Yeah. Thanks, Patricia. So yeah, we have when the dollar is weak, the global economy is doing well, including the U.S. economy. When people feel bullish, when they feel safe, when they want to invest money, they move out of the U.S., out of the reserve, the safe haven, into riskier assets, into things that provide higher yield. Yeah, I am normally flat around if I'm see too much risk. Yeah, I understand because look, there's a whipsaw there. This whipsaw can provide an opportunity, but it can be a whipsaw, or if it can be a samurai sword. You need to know what you're doing, otherwise you'll chop off your hand. Sorry if this comparison is not nice to hear, but anyway, it's you need to know what you're doing. Again, you can mitigate your risk by trading with small position, just trade on a demo account, or just if you have time, sit back, enjoy the show, and that's it. More questions coming up here. Good rule, weaker dollar is certainly on the cards for 2023. Yeah, well, I'm happy you agree with me. You can always jump on the following day with the gift play. Yeah, I totally agree. It's sometimes better to just wait for the dust to settle down before making a decision. When we're talking about the Fed decisions, we have markets positioning ahead of the Fed. Then we have at 7 p.m. GMT, the initial reaction. Then we have at past 7 GMT, Powell's press conference usually gives something for markets to chew on, either positive or negative, in the first 20 minutes. Then you have analysts coming out from commercial banks and our friend there, Nick, from the Wall Street Journal, and also others like Gina Smolik from New York Times and Economist, and you name it. Then we have the Tokyo Open, and then we have the European Open, and the full reaction is only usually European Open or on the following day. So, and it lasts for quite a while, these Fed impact decisions, the impact from the Fed decisions, sorry. Talking quite a lot here. Yeah, thank you for your kind words. Good analysis. Yeah, I don't know how much time we have today. Let's say, I tend not to go over 45 minutes. We have lively questions here. So Let me take this opportunity just to do my marketing pitch. We're in the last hours of a very extended Black Friday campaign. So if you're not in the premium section just yet, let me share the link again, do my thing here. So you can use this link, sign up to premium. If you're unsure, just go for 1 month. It's only $10, well, $9.99 I should say, for the first month, and you can see if you like it, if you don't. And if you want a better deal, I mean, for a longer term, then we have this yearly offer, which is for well, basically 6 months for free, 50% off. So really attractive deals. Yeah, we were unable to convince management to extend these deals. It's a really very low price already, and I think we give good service. Keep on getting positive testimonials. So yeah. Any more questions? Dollar yen. Oh, dollar yen is going down. Why is it going down? Well, because yields are falling. It has a good correlation with the US 10-year yields. They're well off their highs. Intervention also helped. I have to admit, I thought intervention is usually, well, futile. The Bank of Japan intervened on behalf of the Japanese government, on behalf of the Ministry of Finance, to push the yen up despite dovish, extremely dovish monetary policy. Remember, Japan has an interest rate of minus 0.10%, and they're printing yen to cap 10-year yields, 10-year Japanese yields at 0.25%. But inflation is rising in Japan. The intervention did help just a bit, and we've also seen other, and I think markets are already thinking about next year when Bank of Japan Governor Haruhiko Kuroda will leave his job in April, and then another person will take his position, and he might change policy. And in the U.S., yeah, I think dollar yen could move up with strong inflation figures, if I'm right about my assessment of inflation. And then, but then if Powell is indeed dovish, we could see a dollar yen fall. And basically, as I always say, dollar yen tends to reflect, provide the best, or most straightforward reaction to U.S. events, and we have two major U.S. events next week. So I think it'll be the best reflection. No impact of risk on, risk off, no other domestic things to think about. It's usually, I talked about the yen, but it's mostly now focused on the US dollar. Yeah. Can you analyze with charts? Yeah, I didn't prepare any charts today. Apparently daily, yeah, I can pull off, we don't have time for that. Sorry, I didn't prepare charts this time, but I'll take your comment into account. The previous webinar I held, we focused solely on charts, or almost, so I'll do that next time. I'm wondering about the Australian dollar, might move towards the Canadian dollar over the next week. Yeah, I think it will, because I think the Chinese reopening story is stronger than a potential bounce in oil prices. Australia heavily depends on exports of iron and copper to China. Canada depends more on oil. And beyond commodities, both countries are suffering a bust of their housing bubbles. But in Canada, it's worse. So if prices leaped by something like 50% post-pandemic, now they're tumbling down, and the Bank of Canada is showing no mercy, and yeah, hitting home buyers, and it's a bit, despite fast rate hikes, the Canadian economy, the Canadian dollar is not taking advantage of it, and I think in Australia things have a better policy. China is reopening. I think there are better prospects in the next few weeks, you asked, right? So next few weeks I think will be positive. every hour, well, I'm exaggerating, but every day we get something like 5 different headlines from China talking about reopening, closing down quarantine centers, removing the need for testing and for showing a proof of a negative COVID test, reducing the time that people arriving in China have to stay in quarantine. I think they're moving very fast in comparison to the draconian measures they had. They totally changed their propaganda from showing how America is a country plagued by long COVID to, well, this Omicron COVID variant is not that bad. We can cope with it. We're strong. So, yeah, a bit like the book 1984. Anyway, so I think they have to because of these protests. And yeah, they're also loosening on the property sector, which is very important for Australia because we have there lots of metals are used in construction. So I think it's really prospects for Australia have brightened. It's also summertime there. So yeah. Sorry there for not being able to provide a nice chart. I'll take this commentary into account. Anyway, in our premium section, we do use charts all the time. And yeah, so once again, my last pitch for you, if you're still not a premium member, take advantage and trade with us next week. And sign up, take advantage of these offers. Thank you for your kind words. Yeah, I'll have an amazing weekend. Still have Friday. Anyway, for those of you on the premium, you can just also, well, Trading Studio, visit us there. You can follow me on Twitter using this Twitter handle, just my name. Visit fxstreet.com. So yeah, thank you everybody for attending this webinar. And if you want to see it again, the recording will be available usually, well, within less than a day. So just stay tuned. And yeah, looking forward to seeing you soon. And I wish everybody safe trading. Again, if in doubt, stay out. Deciding not to trade is a legitimate decision. You can feel okay with it. And so that's my last tip for now. And so, okay, thank you very much for all your great questions and for coming here today. And see you soon. Thank you and bye-bye.